Good afternoon, everybody, and welcome to this week's macroeconomics analysis session for May the 12th, 2016. You're with DMAC, and sitting alongside me again is Jeff Saffer. Welcome to you, Jeff.
Thank you, David. Hello, everyone.
All right, let's get the session on the road. And first of all, our disclaimer. The content of today's presentation or any other elite wealth material does not constitute a recommendation, nor does it take into account your investment objectives, financial situation, nor particular needs. So before making an investing decision based on the general advice presented in any of the following presentations, please consider whether that advice is appropriate in light of your financial circumstances or seek further advice on its appropriateness. The disclaimer out of the way, Jeff. So this week, market risk assessment. The local market has bounced.
Yeah, so we did one of these sessions a few months ago, sort of late Feb, after the market had really collapsed for 6 weeks and it just started bouncing. And we asked the question from a fundamental and a technical perspective, is this sustainable? And there were some early signs of a rebound in not just indicators or indices that people would normally look at, like the Dow and the ASX, but some other risk indicators. So going forward a few months, we thought we'd take another look at it and see what it says. So obviously the local market's been very strong and overseas markets have been even stronger still. And really just asking the question, is the rally sustainable? What are financial markets telling us?
Yeah. Well, I guess at the time it's sort of, well, what's happening in the background? We were talking about fundamentals and things, and there was a lot of things at the time that were perhaps showing us signs that not all was well. Be interesting to see what's changed.
Yep.
Why has the market bounced? Have the fundamentals really changed that much?
Yeah, and what are different indicators telling us?
Okay.
So we're going to do I'll look at the market. I'll show some things that I look at for the market, and I'll talk about the fundamentals, and then I'll hand it over to you, and Dave will talk about the technicals. So some things that I look at in assessing global risk, I look at VIX, volatility index, I look at yield curves, and we'll look at today in the US and in Australia, and credit default swaps in the US and Australia as well. So those are the 5 things that I'll take a look at.
Good.
Starting off with the VIX. And we can see there that obviously there's a couple of major spikes on that chart. Interestingly, when we did this in sort of mid to late Feb, was if you can look at Feb on the chart there, you can see that spike was just after that high, and it just started coming down. And we said, look, the VIX is coming down. At that stage, it was getting closer to 20. And I said, look, we probably want to see it back towards 15 at the time. And we've now come down to 15, and we've been hovering around that level for almost a couple of months now. So the VIX is definitely under control. And investor uncertainty is much, much lower than it was. And after a big spike up like that, I'd want to see it fall below 20. That's happened, and it's definitely stayed there. So happy to that's a good sign for me. It's a bullish sign.
Yeah, it is a bullish sign.
Makes me comfortable about putting my money in the market. The yield curve. So what we've got there is looking at US Treasuries with different maturities. So like a 1 month T-bill. So what do you get paid for lending money to the US government for a month, for 3 months, 6 months, all the way, and they have 30-year bonds or 30-year treasuries. So that's what the curve is showing. Effectively the forecast interest rates in the US over the next 30 years. And what I've got is a few lines. So we start at the top, which is the dark blue, and that's what the curve looked like 6 months ago. That's now... The next 2 lines are obviously much lower than that, and that shows that the market is now factoring in lower interest rates in the US over time compared to 6 months ago. So they are more dovish, and a significance of that is that if you think a country is going to have low interest rates, generally speaking, it translates to expectations of low economic growth. If you think a country is really going to start kicking some economic goals, then you would expect interest rates to go up. And that is the case. You can see that's what we call a normal curve, where in the future interest rates are higher. But you can see the dark blue dotted line is very curved, like a normal sort of parabola. An ex-science teacher, you can probably help me talk about some of this. Then the next two lines are much flatter and not as steep. So just showing how interest rate expectations have come down.
Yep.
So that's, look, it's still positive, but it's not as positive as it was 6 months ago.
Yep.
In Australia, the lines are going in the other direction. So starting 6 months, still in the same direction, but the top one is 6 months ago, followed by 1 month ago, the yellow line, and then the hard green line is currently. And so you can see those are coming down quite a bit. So the long-term expectations of interest rates and short-term really in Australia has come down. And also that really suggests that the market's pricing in less economic growth in Australia compared to a month ago and 6 months ago. That's quite a big, between the bottom two lines, that's quite a big change for just in 1 month.
Yeah.
And that's since we had the CPI data and the RBA's cut
the
rates.
RBA,
So that sort of was a bit of a game changer. But definitely it looks like lower rates ahead.
So if I'm reading that correctly, it's suggesting that we could have. Is that cash rates? Is that
Essentially it equates to the RBA cash rate, and it suggests that the cash rate is going to get down towards say 1.5%, so one more rate cut in the next couple of years, and then they'll bottom out, and then over sort of 4, 5, 6 years plus down the track they'll start.
That's good news for homeowners then.
It's excellent news for homeowners, but I mean you have to remember that rates are essentially at emergency levels. Very, very accommodative, and they shouldn't really be this low. They're only this low because something's wrong. So, look, I've got a mortgage. I'm happy to pay less on my mortgage, and I've got some investment loans. I've got plenty of debt out there that I've used to invest, and so I'm happy about low rates. But it's not really a good sign for the economy. I could tell you that. Look, maybe interest rates will go to zero in the next couple of years, and you'd say that's fantastic. The only problem is if interest rates go to zero, 5 to 10% of the people that are listening today won't have jobs, and the economy will be pretty stuffed. So it gets to a point where lower interest rates are not necessarily a good thing.
Yeah, I suppose that with that as a backdrop, without going into too much, if interest rates are low and people have been saving for a period of time and making good use of taking advantage of the low interest rates, at some point they'll feel more comfortable to start spending again. And then potentially the cycle starts to turn around a little bit. Yeah,
look, that's definitely true. The only thing I would counter that is that if you, say, are retired or approaching retirement and you've got a lot of your money in bonds and cash accounts and term deposits, you're not getting the return. And then you're not making enough money to then go out and spend. So it depends which side of whether you're a lender or a borrower, really. But look, that's probably, to be honest, that's a bit worrying. It's not a good sign. The next thing is credit default swaps rates, and this is of investment grade companies in the US. So this basically says how much does it cost to insure against a loan, money lent to a company in the US. So if you lend money and the economy starts struggling in the US, there's an increased chance that those companies will default. So it costs more to insure against the default. So you want to see this as low as possible. If insurance rates are low, it means there's not a lot of risk. So you can see there that mid to late Feb is when we covered this, and it had really spiked up quite significantly, sort of 50% in a few months. It's now come down quite a bit, and now back down to pretty much the lowest levels it's been in a year. So that makes me feel much better. The only thing I will say is it did spike up during reporting season in the US. So the reporting season was a bit mixed, and the market is a bit more worried about companies post reporting season. But still, that's better than if we were near the peaks there. Not sort of similar in Australia. Certainly, we had a much bigger run up where. The CDS rates almost doubled in under a year, which is a worrying sign. Okay, that really shows that the market is getting much more worried about the viability of companies. It's not really suggesting that they're going to go bust, but it's gone from a very, very, very small risk to a very, very small. 3 varies to 2 is actually a big deal. So what we've obviously seen, that's fallen quite a bit since February as well, but much closer to the peak than the US. So in Australia, things have improved in the last few months, but are still, a little bit shaky. And much worse than it was a year ago.
Yeah, looking at that just from a purely chart-based, you'd like to see that first of all get below that 120 level there on the chart, and then start to gradually move down. Would suggest to me that maybe the worst of it's over.
Correct. And essentially, if you're bullish on the market, you kind of want to treat this as a short, and like you said, you want to see it crack new lows and go back down. So it's holding up for the moment above those levels, and if that started creeping up higher, that would be a bad sign.
Concern. Yeah, interesting.
And definitely in contrast to the US, where it really has fallen back.
Yep.
The US is just a little bit.
It just seems to be holding up there at the moment, doesn't it? Yeah. Okay.
So if I put all that together, the VIX I've got in green. That's definitely a good sign. Back down to 15 makes me feel better.
Yeah.
The yield curve in the US is positive, so it's got the right shape, but it's flattening. So I've put in a half green there. It's positive, but not great.
Yep.
The yield curve in Australia I've put in red is not a good sign. The fact that it's what we call inverted, so it actually goes down rather than up. And particularly weak over the next 2 or 3 years.
Yep.
The CDS index in the US is falling, and it's back down to sort of reasonable levels.
Yep.
The CDS, I've got orange is neutral, is falling, but not falling by as much as it is in the US.
Yep.
So we've probably got, one very good, one very bad, 2 slightly good and 1 neutral. So we're slight. I'd say put all these together, and the bias is moderately bullish.
Yep.
From these risk indicators.
Good.
And that's my take on things.
Beautiful. All right. So what we might do now is Alt Tab, I think, is the word there, Jeff. And with a little bit of luck, I can bring up Beyond Charts. There we go. Technology is wonderful when it works. And just go through some key indices here. And S&P 1500, really interesting. Last time we had the big spike in volatility way back in January, February time. And that's illustrated down the bottom here with the increase in volatility above a longer-term moving average. And most of the time when we get those spikes in the volatility increasing, it's generally associated with it tends to be more downward directional movement than upward. So that's just something to notice as you go along. And volatility has importantly dropped off, and we've seen the market recover reasonably well as well. In fact, a pretty strong rally from those levels. In the ASX here, again, volatility is reducing. We're starting to get a little bit more upward directional bias, if you like. Our risk indicator is now up into what we would call low risk, and that's the first time that's happened in the last 12 months. So positive sign for our particular market. Just going through, this is the Japanese market, the Nikkei. And again, I'll just put on a swing chart there just so we can see peaks and troughs, etc. Look, really very neutral at this point in time. The market has, again, this market can swing a lot when compared to, say, the Australian market. Big moves up, big moves down, and this was certainly leading some of the markets in around January, February time, and looked quite bearish. It looks like it's trying to keep its head above water. The main thing here is, look, the longer-term moving average is pretty flat, and we're just hovering around that at this point in time. So no real clear direction there. The DAX, the German market, not dissimilar, perhaps a little bit more positive directional movement. The longer-term moving average starting to move up a little bit, still hovering around it, and from that point of view, the I guess the bias is still fairly neutral as well until we start to see, the price action drag up a trend indicator. We've got the 30-year bond there again. It's been quite bearish for a period of time. It's trying to regain a bit of strength, so certainly picking up a bit of a directional movement. Again, still fairly flat, and again, this could move any way pretty quickly as well, depending on what sort of news comes out of the market. So again, fairly neutral on that for the time being. Clearly, when we last talked, Jeff, we were in January, February, and this oil market was right down in here in the doldrums. And how low could oil go? Could it crack $20 a barrel? Since then, we've turned around. Here's our trend indicator. We've closed above that strongly. We've come back to retest. This is a really positive looking chart, and so that's actually looking quite bullish. So obviously,
yeah, that's really the first one that's also put in higher peaks and troughs in recent times. So
you sound a bit like a technician there, Jeff. It's good to see. I didn't think you'd ever get to that particular level.
Brought me over to the dark side.
I have brought you over to the dark side. This is the all countries world index, ACWI. So this is basically a benchmark, if you like. If we added all the global markets together, put them on one chart, this is kind of what we're seeing. And interesting that we were in bear market territory. Things were looking pretty dreadful, but globally markets have rebounded pretty strongly, and again dragging that longer term indicator towards the upside. It's coming back to retest that at the moment, but overall not looking too bad. So bullish on that for the time being. The dollar yen, again, we talked about this as being a bit of a flight to safety. So this currency pair, when there's fear around, money flows into the Japanese yen at the expense of the US dollar. And so in terms of a relationship between the strength of the US dollar and Japanese yen, if the Japanese yen is going up and the US dollar is going down, then what we're going to see is a chart quickly moving to the downward side, and that continues to be the case.
And you and I have talked for months and months about we've been bearish on the US dollar, and both of these really to an extent are reserve and safety currencies, but it's which side of the coin it's sort of flipped on. So the fact that money has flown really out of the US dollar and into the yen. When even often the US dollar is seen as a safe haven, not at the moment.
Yeah, absolutely. So if we go back and do our alt tab thing there again, Jeff, with a bit of luck, we'll get onto the right slides and a quick summary. So these are the indices that we've just gone through, with a little bit of an explanation on each of those. Good to see that oil's actually bottomed out. Key equity markets, it has been a bullish week. The S&P 1500 and the Aussie market are back above key longer-term trend levels. So that's a positive sign for those particular markets. Oil really rebounding strongly. Now, whether or not that's a demand-supply issue or whether there's something more fundamental in the background, Jeff, you can probably talk a little bit more about that. T-bills very much neutral at this point in time, and again, depending on what news comes out of the market, they can move pretty quickly, either upwards or downwards. And just finally, the US Japanese yen pair is still looking extremely bearish, and whether or not that's strength in the Japanese yen or weakness in the US dollar, or a combination of both, that trend looks far from wanting to bounce at this point.
Yeah, and I mean, look, perhaps oil should probably be in green on that one, because that was looking fairly good. So I think you've probably got a bit of a mixed picture on the technicals. Certainly, equities are, like you said, Australia and the US looking okay. Some of Europe and Japan looking a bit shaky and probably at important levels. So, overall, probably neutral or maybe even slightly bearish on putting all the charts together.
Yep. All right. That's it, folks. Just a reminder that the ETC session at this stage will either be a recording over the course of the weekend or a live webinar on Monday morning, but I'll certainly notify everybody of that. Thanks, Jeff.
Thank you, David.
Bye for now.